The fintech company that we will be presenting on behalf of today is Coinbase. Today's agenda will include a brief summary about Coinbase, value at risk and expected shortfall calculations, Basel Accord 2 and Gaussian model calculations, regulatory and compliance implications along with a brief compliance plan, and also a short segment around credit risk modeling. Coinbase is an online cryptocurrency exchange that was founded in 2012. Users are able to leverage this platform to buy, sell, and store many different cryptocurrencies. Coinbase has been and continues to be a major staple in the evolving crypto market. Their portfolio consists of many assets, and our team has picked 3 of those assets to perform risk analytics. We will jump right in by starting the discussion around value at risk and expected shortfall. Over the next few slides, we will discuss the methodology and results associated with value at risk and expected shortfall. Just some high-level steps that we took to calculate the value at risk and expected shortfall is, of course, data collection, determining the portfolio amount and asset allocation, calculating portfolio value and losses, and of course, getting the results for the value at risk and expected shortfall. By using Coinbase's 2023 quarter 2 balance sheet, we were able to pick 3 assets to use for our calculation. We have USDC, which is US dollar coin, for $315,508,000. We have their amount of crypto assets held, which is $485,347,000. And then we also have real estate related to property and equipment for $186,046,000. This pie chart displays Coinbase's portfolio allocations based on the 3 assets that we selected. So roughly about 49% is allocated to crypto assets, approximately 18.8% is allocated to a real estate asset, and the remaining 31.9% is allocated to US dollar coin. Slide 8 displays the value at risk and expected shortfall calculation results using a historic approach. Value at risk is used to determine an asset's maximum amount of loss over a specific time period at a certain confidence level. The expected shortfall is the maximum number of losses if the value at risk is exceeded. Based on our findings, the value at risk and expected shortfall are both lower for the portfolio as a whole in comparison to the individual assets. To give an example of what this means, BitQ has an approximate maximum amount of loss of $31,000 at a 95% confidence level. If the losses were to exceed that amount, we have an expected shortfall of an approximate amount of $40,000. I've also completed these same calculations using a parametric approach. The difference between the historic and parametric approach is that we calculate the value at risk and expected shortfall based on parameters such as mean and standard deviation. Using this approach, the results can differ. For example, BitQ has a value at risk of roughly $35,000 at a 95% confidence level compared to the previous $31,000 using the historic approach. The expected shortfall is now roughly $44,000, whereas when using the historical approach, it was around $40,000. In conclusion, we are able to see that BitQ has the largest value at risk and expected shortfall using both methods, but we know that this is because it accounts for 49% of the overall portfolio. The historical method captures all events within a certain time period, whereas the parametric method assumes that the events are normally distributed, and that may not always be applicable. Depending on which method is used, the results can be different. We are providing our results in thousands, but in a real-world scenario, this is considered millions of dollars and can be detrimental to company performance.
In Milestone 2, we will be covering risk-weighted assets, Basel Accords 1 and 2, and the Gaussian distribution. We will be covering data collection through Coinbase's balance sheet, the worst-case default rates and risk-weighted assets, Basel's 1 and 2 requirements, and the Gaussian model and distribution.
Here on slide 13, we have another screenshot of the 2023 quarter 2 balance sheet This displays the accounts and loans receivables net of the allowance for doubtful accounts. For the sake of the exercise, we did add back in the allowance for doubtful accounts.
In banking regulation, various approaches under the Basel Accords determine risk-weighted assets differently. Basel I assumes all assets are 100% risky, while Basel II's standardized approach considers a range of risk weights and credit ratings. Basel II's IRB approach permits the use of banks' internal credit ratings for assets. Coinbase's worst-case default rate is 28.45%, which signifies the probability of the most adverse outcome, serving as the worst-case scenario. In terms of capital requirements, Basel I's IRB approach calls for $73,227, which is significantly higher than the standardized approach requiring $17,621. Basel II's IRB approach requires $36,613, while the standardized approach mandates $8,810. Notably, the Tier 1 capital required aligns with Basel II's IRB approach at $36,613. With a BIVAR of 89.4%, there's approximately an 89.4% chance that BitQ will experience a loss less than 5%, and CCI will occur a loss of less than 3% over the next year. This indicates the need for investors to set aside both the minimum capital requirements and sufficient capital to cover potential losses associated with these assets. This chart shows the bivariate normal cumulative distribution for the Gaussian model. In conclusion, the Basel Accords play a vital role in the world of banking and risk management. Basel I requires a significant capital reserve and overlooks the nuance of credit ratings, while Basel II and its standardized and IRB approaches provides a more comprehensive and flexible risk assessment. The Gaussian copula model, with its remarkable correlation of 98%, offers a powerful tool for assessing the probability of events between cryptocurrency and the real estate ETF. Together, these frameworks underscore the importance of robust risk management and the capital adequacy in ensuring the stability of the financial sector.
Moving on to the third milestone, we will discuss regulatory and compliance implications for Coinbase. Basel I, II, and III are accords created starting in 1988 by the Basel Committee on Banking Supervision, and basically these accords are regulations put in place to keep banks safe and stable. And as time went on, these regulations got more and more advanced and more detailed with Basel II and eventually Basel III, accounting for things like credit risk, liquidity risk, leverage, and several other vulnerabilities within the banking sector. Fintechs and really Coinbase more specifically have a very interesting and unique relationship with the Basel Accord, just given their positioning and kind of the interconnectedness between banking and technology. Specifically for Coinbase, one of the Basel Accord pillars that is particularly important is the need for capital adequacy and having enough capital on hand to account for the extremely volatile cryptocurrency market, and just accounting for potential black swan events is something that Coinbase needs to be extremely dialed in on and pay very close attention to. Shifting more to the regulatory and compliance implications methodologies for Coinbase specifically, we're going to go ahead and hit 5 categories: regulatory compliance, data sharing and reporting, capital requirements, collaborations with banks, and regulatory sandboxes. So these will be following in the next slides. Regulatory compliance is a very interesting discussion to have surrounding a company like Coinbase, just due to the fact that they're subject to things like anti-money laundering and know your customer requirements, which they combat or account for by requiring photo ID and other measures, but also they're responsible for the rapidly changing environment of cryptocurrency and technology as a whole. And they're actually in trouble with a $6.5 million fine coming from the CFTC surrounding misleading information regarding derivatives trading. But just continuing to implement and be on top of, be on the leading edge in terms of regulation changes is something that Coinbase should continue to do in the future. Data sharing and reporting is something that Coinbase is currently in the news with a couple incidents. One being a hacking into an account of losing over $100,000, and another one being the ongoing investigation surrounding the utilization of customer fingerprint and Face ID data. So just the ways that Coinbase can continue to grow in this area and continue to strive to mitigate some of these issues is just continue to be transparent with customers in terms of what they're doing with their data. And they do require all customers to agree to their privacy policy and upon signing up. Just continue to push this and continuing to strengthen their cybersecurity networks to prevent future attacks as well. So discussing capital requirements for Coinbase, Coinbase does hold money transmitter licenses in each state, requiring a large capital reserve. They have over $8 billion in Ethereum staked, with $2.2 billion for institutions under contractual constraints. Despite the $5.5 billion they do have in cash and customer liability accounting, a sudden black swan event could put some serious stress on the company. And this is obviously a potential vulnerability for Coinbase. And as they continue to grow and understand the market better, they should continue to build a larger and larger capital reserve to account for a potential black swan event in the future. Coinbase uses collaboration with banks pretty well, allowing customers to link a bank to allow for withdrawals and transfers into Coinbase as well. Coinbase does report all incomes and keep data for up to 5 years as well to cooperate with all investigations. Some gaps that they need to work on are the fact that some banks are pulling out of utilizing cryptocurrency as much due to the potential fraud. The way Coinbase can combat this is continuing to increase their cybersecurity and continuing to market the trustworthiness of the blockchain as well as cryptocurrency.
Coinbase is actively leveraging regulatory sandboxes like the MAS FinTech Regulation Sandbox and the Coinbase Developer Sandbox to test various projects in controlled environments before public launch. Coinbase also allows consumers to test transactions on new networks without monetary value. While there are currently no issues in this process, the company must stay vigilant about potential regulatory changes in these testing environments, adapt its approach accordingly, and maintain open communication with regulators to ensure compliance. This proactive stance is essential to navigate the evolving landscape of fintech regulations.
In our last section, we will be discussing credit risk modeling and probability of default. Over the next few slides, we will discuss credit risk modeling and default methodology. We have our high-level steps listed here of data collection, calculating hazard-free ratings, calculating real-world hazard ratings, and also calculating our capital requirements based off these probabilities of default.
Risk-neutral hazard rates are probabilities of default found using real-world metrics under the assumption of a risk-neutral environment, and they're typically found using a CDS spread and then dividing this value by 1 minus the recovery rate. However, in this instance, a bond spread is used in place of a CDS spread to arrive at our hazard rates, which are seen at the right side of the screen. The accuracy of this model does largely hinge on the relevance and accuracy of the recovery rate that's used. 40% was used in this scenario as an approximation for the recovery rate of Coinbase.
Real-world hazard rates are based on historical market conditions and represent the default density at a specific time, such as 2007. By using global corporate default rates for speculative grade ratings, we gain insights into two critical metrics, the default probability at time t and the probability of default that has not occurred at time t. To calculate the hazard rate, we simply divide dt by st. When we're examining our high-yield securities, we observe the maximum hazard rate occurring around year 3, followed by a significant decrease over time. Real-world hazard rates can surpass risk-neutral rates due to factors like market volatility, risk premiums, and an elevated risk of default. These elements contribute to the differences between those two types of hazard rates.
This chart is a representation of the comparison between real-world hazard rates and risk-neutral hazard rates, just to give the audience an idea of how those probabilities of default can differ between different terms. This is a screenshot of the last part of the credit risk model that captures capital requirements. Using Coinbase's $440.5 million in consumer loans, we were able to calculate the capital requirements using risk-free rates and real-world rates. We can see how much capital is required using both Basel I and II. The probability of default in terms can be changed using a selection as well as other inputs. We recommend that Coinbase continue to monitor the crypto market for volatility due to their consumers using Bitcoin as collateral, and to consider requiring customers to use cash as collateral to ensure capital requirements are met.
Coinbase's lending approach primarily caters to a diverse range of riskier customers who engage in the cryptocurrency market. To maintain financial stability, it's crucial for Coinbase to closely monitor the volatile crypto market and maintain a robust capital reserve to mitigate potential consumer defaults in unforeseeable scenarios, such as a market crash.